Good morning. Welcome to the Virginia Waterwell Association 2025 Virtual Education. We appreciate this morning that we will have Anya Frazier presenting some equipment financing course. And at this time, Anya, welcome, and we will hand it over to you.
Thank you, Christina. It's a pleasure presenting at the Virginia Waterwell Association this summer. Just a couple of words about myself and why there is such a strong interest from our side to participate in those educational sessions. I've been in the equipment financing industry for over 20 years now, and I've been supporting the waterwell industry over the last several years. It's an industry I have grown very fond of, and there's quite some items that are very particular about the industry in a very positive way. And I'm working more and more with different customers, no matter if you're very small, mid-size, or larger. I felt like there was always the same hurdles that we had to overcome when we talk about growing a company or hearing them. We would like to have a new piece of equipment. And I know you might see a lot of drilling rigs here, but the session today is not necessarily that you have to buy a new drilling rig, of course. It's in general buying any type of equipment that you need to run your business or to grow your business, and what are the tools that you have available to do that. Again, my background is in equipment financing. I run Bauer Financial Services. It is 100% owned by Bauer Jeffco. Jeffco makes the waterwell drilling rigs. But just because we have that association with Jeffco doesn't mean we cannot help you with questions in general related to your company or when you buy any other equipment to run your business. So my personal goal is to help as many companies, educating them what is available, what are the options, how to look at things maybe a little bit differently than 10, 20 years ago. And because this is a business that is passed on from generation to generation, typically, we unfortunately see it sometimes now that businesses are sold or just literally closed down because they don't have any successor. But if you're passing on the business from generation to generation, a lot of things have changed. And I've done quite a bit of educational sessions. I presented 3 years in a row at the Jubilee. The last one was just a month ago. I have one of the presentations here today as well. We presented at the Georgia Waterwell Show, at the New England Show. We're actually going to do a session at the National Groundwater Show, end of November, December. It's just my personal goal to reach as many people as possible and help them with questions that they have. Equipment financing and financing in general can be a little bit of a people get hesitant about it because it is a big undertaking, and kind of lowering that stress level and make it more obvious what to do and how it all works. That's what my goal is today. Some of it might apply to you right away. Some of it might just apply to someone else that's listening today. I'd like to repeat what Christina said. This is for you. This is not a presentation for me where I feel like I need to tell you everything in detail that's on the slide. This is a presentation for you to learn and to educate yourself. So if you have anything, please feel free to interrupt or say, can you explain this again? Or I had a different experience, because this is really for you, that you walk away with more information at the end of the 2-hour session. So jumping into it, we have 3 different presentations. The first 2 is about 30 minutes. The third one is what I did at the Jubilee, which is closer to an hour. So we should get to an hour 45 at the end of the group this morning. The first set is why equipment financing is essential for growing a company. So this is more in general, talking about why do we actually talk about equipment financing. We all know that growing a business is something we all get to at some point. I see a lot of companies that have tabletop drives that are 25 years old or 30 years old. And I always say, congratulations, because it means you kept the equipment really well, you maintained it, and you treated it well, that you can still keep it running. But every company is coming to a point where you have to upgrade, or the equipment breaks down, you can't get parts anymore, or you've only done pump service and now you want to grow into drilling. So everyone is in a different spot. But one thing that is common for everyone, if you want to grow, replace, or want to make a change, you need more resources. That's not only money and equipment, but that is also people. And it is very common in the water well industry to spend what you have. So we all save up. We have like our little piggy bank and we save up our money for it. And then what we can afford is what we're investing, but that might not always be the right way today to grow your business. So equipment financing is really special in the sense that it's not your typical banking relationship where you just talk about, you go to your bank and you say, I want to buy a piece of equipment. And then he looks at your financials and then he has a lien on all of your assets that you own in the company. Equipment financing speaks specifically to the equipment you want to finance. And it's a little niche, so to speak. There are different lenders that offer this, and we will talk about that on a different slide. But this is how nowadays, if you want to grow your business, this is how you grow it. If you think a little bit about housing, anyone who wants to buy a new house or home today, it's very rare that we can pay cash for it up front and then we're debt free. We all have to finance the equipment or the house we want to live in and have a mortgage on it. So it's the same concept. Why does cash matter? I hear a lot, cash is king. And I like to say it up front. I don't like to have debt either. I have very limited debt. It feels really good to be debt free or have limited debt. And when people say cash is king, and if I can pay for it, then that's great. But cash is a really important resource for you to have, and to spend it wisely is important. So cash matters for your day-to-day or monthly operational expenses. You need to make sure you have enough for your payroll. You have to make sure you can have enough money for supplies and inventory. Marketing is becoming more and more important. I know we have smaller regions in the water well industry, and there's a lot of word mouth to mouth. Some of you are so busy that they're actually pushing business away. But the newer generation is focusing more on marketing, be it social media, having a Facebook account, or being listed on the Triple B website. These are nice things to have. Keep in mind for emergencies, right? That maybe the engine is breaking down, and that is another $50,000 investment that you have. So cash is king. Protect it. It's a really important resource for you to have. Don't invest it all at once in buying equipment. Preserve your liquidity, and we will look at how that looks like. So equipment financing, why do we like to talk about equipment financing? If you don't pay cash up front, if you basically pay like a mortgage, right, is a really good comparison. You have your monthly payment until it's paid in full. If you talk about equipment financing, you can avoid the outdated equipment. If you buy new equipment nowadays, it's often a sticker shock for a lot of people, because you can't buy a new drilling rig for $500,000 anymore. So it's a big investment. And if you look at rigs nowadays, they're a lot more safer in the way they're set up. They're have a lot better production. And that is how you grow your business. So with equipment financing, you can avoid to have outdated equipment in your fleet. I'm not saying update your equipment every 5 years. I think that is overkill unless you are a larger company. But updating equipment right around 7 to 10 years could be a good strategy for your company. You're more than welcome to keep it 15, 20 years as well. Once it's paid off, it's basically a cash cow, right? You don't have any more costs unless you have any maintenance, and you have a lot of income then generated with it. But these older rigs at some point, I think they just get inefficient and might cost you more. 100% financing, that is something I always like to bring up. There's nothing wrong with putting money towards any type of equipment you're buying. You're more than welcome to finance 50, 60, 70%. Putting equity towards it lowers your monthly payment, but don't feel like you have to. That is something that I'm breaking into more and more in the water well industry. There is 100% financing available. The reason why I say this, if you're talking about a bigger water well drilling rig, we're talking about $1 million plus in purchasing price. It is very common for any type of manufacturer to ask between 20, sometimes even 50% of a deposit. That is money you have to put up front to secure the piece of equipment. If we talk about $1 million, 20% is 200,000. So that is a lot of money to take away from your cash. And that is maybe needed to secure the rig. But when we talk about financing at the end, that is money you can have back in the pocket. So this is something I think a lot of people are not used to. They're used to having to put money towards it. Again, you can, that's okay. No one will say, we don't take your money, but it's not a requirement. With equipment financing, you can improve your cash flow. It's basically, you have just your scheduled monthly payment. You know exactly what you have to pay in order to service your debt. You don't have a spike, so to speak. You can have flexible terms. We have done anything, terms with 7 to 8 years. We have done seasonal payments. We have done shorter terms. Larger companies sometimes like to have more of an off-balance structure, so to speak. It's not very common, but there is a lot of flexibility in equipment financing. Build credit is another thing that's important for this industry. The water well industry, because everyone is used to pay a lot of things in cash and not borrowing money, it's just like not having a credit card in your personal life. If you don't have a credit card, you're not building up a credit report. So you don't have credit history, and that can be an issue. So if you always pay everything cash on the business side, it's the same story. So even if you buy smaller pieces, if you buy a water well truck for 250,000, or it might be used and it's 100,000, or it's a hoist truck, or whatever it is, don't shy away from financing it, because it helps you build a credit history. And you don't have to be tied to the financing for the rest of your life, so to speak. If you set it up for 5 years, as an example, you can pay it off after 2 years, but you're building that credit history. And that is something you really have to keep in mind, because it's just helping you run your business better over the long time. Another thing, product bundling, I want to bring up. You can finance equipment. You can also finance tooling. If you buy a new piece of equipment and you need some rods with it, that is available too. You can also finance the casing hammer that you might need. So a lot of people think, okay, I buy for the rig and then I pay separate in cash for the tooling. You can all combine that together and keeping that cash outflow as low as possible. And the last topic I want to talk about on this slide is hedge against inflation. It is honestly a topic that never made a lot of sense until we hit COVID. And why do I say this? Is because buying a rig prior to COVID was so much more cheaper than it is now. And what hedge against inflation basically means is that we've seen this through inflation and more through the COVID periods. Everything costs more every year after year. Through COVID, we saw a big jump because production increased supply chain increase. So rigs all of a sudden got 10, 15, 20% more expensive. I personally wish I would have bought a rig in 2019. I would have saved a lot of money. I could sell it for a lot of profit now. But don't think I don't invest now because I'm gonna get a better deal next year or in 2 years or in 3 years. I don't think that's really how it really happens at the end. If you might find a better used rig at a better price, but don't gamble and think the equipment price will go down in a year or 2 or 3. It typically actually does go up and sadly never goes down. So what's the process now? You kind of get to the point. What does equipment financing look like? The simple process is you apply, we go through the process, how that application works, you get approved, and then you have the disperse of funds. So the manufacturer, the vendor gets paid. That's in simple terms. There are different ways in getting there. There is the traditional financing. That's what we're all used to. Traditional financing means you go to your bank or a different equipment lender, and you say, I want to buy this piece of equipment. Here are my financials. Then they go into underwriting. So that means a credit analyst will start looking at your financials or at your tax returns. He might ask you some questions, and we have a deck about that, what to expect when we go into credit. And then hopefully we get to the point it gets approved and then it gets funded. That's your traditional underwriting. Very similar to a mortgage. Mortgage is just on the personal side, but that's the business side. Typical terms are 7 years, 8, sometimes even longer. There is the option to go shorter. I think that could be interesting for some smaller investments, but typically most companies go 7 years, sometimes even 5 years. An option that is very unfamiliar in the water well industry, and we're pushing this more and more now, is the small ticket or credit application only. There are different programs out there. Some go up to 250,000, some go up to 500,000 or even 700,000. And what a small ticket does is basically covering a small investment, but it is a much quicker and easier process. Small ticket, you don't need to provide financials. It goes by the credit scoring of your company. So we talked about that, building a credit history. On the personal side, you have Equifax or Experian that tells you what your credit history is or credit score on the personal side. And that exists also on the business side. There are different bureaus who have that reporting. Experian is one of them on the business side as well. There's PayNet, that is another one. But basically, based on those business reports, the small ticket runs through those reports and have you approved or not. It is quick, it is easy, and it gets equipment moving fast as long as you fit within their parameters. We are using the small ticket quite a lot in the water well industry. We are using it for water trucks a lot. We're using it for used equipment. It doesn't always have to be new. So again, like as working for a manufacturer, new is always the go-to, but you don't have to buy new. You can get financing for used equipment as well. It might take a little bit longer just to understand the age of the equipment and the hours, but that is doable as well. So don't only think new and get sticker shock. There's also financing available for used equipment. And then really the important part here is I have been through the financial crisis. I had very small companies in that period, and I can see how devastating it can be when the market slows down and the bank knocks on the door and wants their payment, but you don't have money coming in. It taught me personally a big lesson. I worked for a bank back then. Now I have a lot more freedom because I get to work with different banks and really provide the service to the industry that is really key. But what I've become a really stickler about is personal guarantees should not always be provided upfront. Sometimes it can't be avoided, but it's not, a personal guarantee will not make the deal go green, so to speak. The company history has to work, the company credit history has to be okay, the equipment has to be okay. And if that is all good and the lender still requires a personal guarantee, then it is okay to provide. Don't have the assumption the the credit doesn't like the company, the credit doesn't like the equipment, but if I give a personal guarantee, then it's all good. It doesn't happen on the business side like this. So I've become a stickler about personal guarantees, that is not something that should be provided upfront, even when they ask for it. This is your business and this is your lifeline. So it is okay to ask questions. It is okay to push back. You can say, we can talk about a personal guarantee later on, but right now I would just like to know, are you able to get me approved based on my corporate tax returns, on my business history, and the relationship we have? I see this a lot. People are getting very hesitant when they talk with banks or lenders because they want to be friendly, polite. They want to get an approval. They don't want to upset anyone. And I'm not saying be rude to them in any form or way, but it is okay to be proud of your business. It is okay to push back and protect yourself. Nothing is worse than having money worries. It brings you sleepless nights. So no personal guarantees is a good way to start it. And then also the collateral. We talked about this at the beginning. Banks typically like to have a lien on all your assets. What does that mean? Anything that you own in your business, they would have a lien on. So you might just finance a water well drilling rig, but with the lien they have, if worst case scenario and you can't make your payment, they also have a right to get your water truck. They also have a right to get your truck that you're driving in every day. That's what a lien on all your assets mean. And when you talk about financing, it doesn't matter if it's with me or with anyone else, try to make sure it's only on the asset you're financing, right? Again, let's go back to the mortgage. Only the mortgage on the house. If you have maybe a summer home somewhere else, or you might have a boat on the lake, you don't want to tie up that summer home or that boat as a security as well, right? So kind of keep things separate. So that is something I always find helpful to go through, is how does that process look like from start to finish? Some of it might be logical, but some of them are very tricky with the timing. So naturally, right, you come across, you want to buy a new piece of equipment, maybe you want to update your equipment, it broke, you want to grow, you might want to acquire a company and need newer equipment. It doesn't matter what it is, but you have need for new equipment. So you start looking, what are the manufacturers in the market? What's the availability of the equipment? Maybe you can buy some used equipment through the manufacturer, but maybe through a different company, right? There is the option to get financing done even if you buy from another business. Again, that's not everyone's cup of tea on the equipment financing side or on the banking side, but that is an option as well. So you start selecting your vendor, you start looking at quotes, you ask about the timeline. Is it available now? Is it available in 6 months? When can I basically expect the delivery? And then you have to ask, is there a deposit? The highest I've seen from a manufacturer with a deposit is 50%. That's quite steep, in my opinion, but I've seen it. 20% is more or less normal. But they also want to make sure you're not walking away from the deal at the end. Deposits are more or less negotiable if the delivery is going to happen very soon. Let's say the equipment is in their yard and it can be picked up next week. A lot of dealers or vendors are more flexible with deposits, but if they're still in the building process, it's a different story. So knowing if there is a deposit and when is it due is really important. And then how you're going to pay for it, right? You have to start that process either at the same time as talking to the vendors or dealers about the equipment or shortly after, because this process might take just 2 weeks, but it might take 6 or 8 weeks. It depends on who you're talking to and who you're working with and what your background is. So you have to figure out, do I pay cash for it? We talked about it. That's not always your best option to put all the cash in the equipment. If you have abundance of cash, by all means, you don't need to finance. How much do I want to finance? Do I want to finance 100%? Do I want to finance 80%? And then how do I going to pay for the deposit? And I want to have the money for the deposit back? So these are the things you have to think about. Then you pick your lender, and we will talk about that again on a different slide. What are my options? Who can I work with? But then your commitment is basically you go through the credit process with a lender, you go through the financials, or you do the small ticket, which we talked about. A lot of customers do not want to sign a sales contract with the dealer until they're credit approved. And this is why I said you got to start that process early, because you don't want to lose the option to buy something. Maybe you got a special deal. Equipment is sitting in the yard and they're giving you a special price because it's readily available. You don't want to lose that deal because you haven't done the financing yet. Financing is approved, then the payment goes to the dealer or the vendor, and at that point, the delivery happens. So this is the process and how it is broken out. And now here's the slide I've mentioned a few times. So who can you actually talk to? Everyone always talks to their primary bank, and that's totally fine. This is the bank you have your relationship with. This is the bank who knows you the best. This is the bank who has your checking account. This is the bank who has your savings account. Most likely you have financed your home with them, right? So they know you really well, and that is a good option to reach out. But that's not the only option you have, because what I'm hearing from a lot of customers is that they're frustrated with the process of their primary bank or their local bank. It's the questions they're asking. They're not familiar. They're familiar with your business, right? And how you're paying your bills, but they don't understand the equipment you're using. And why is that important? Because they might come back and say, I finance it, but I do want that 20% down or 30%, and I will only go 5 years. So this is where you have to look into what are the other options available. If you don't have 20% to put down, and if you want to go longer than 5 years, you have to look at different options. A good rule of thumb, if we buy any type of equipment, is to look at 3 different quotes, right? You usually don't go with the first one. You want to make sure you got a good deal. So you look around and get a second or a third quote. This is the same thing when we talk about equipment financing. I know this is work, and I know it takes time, but this is your money, and your money saved if you make the right decision. So don't skip that due diligence when we talk about equipment financing. So we talked about your primary bank. So who else is giving money out in the water well industry? A lot of banks have also an equipment financing entity. So Wells Fargo has an equipment financing entity. Bank of America has an equipment financing entity. There are other larger local and national banks that are specialized in equipment financing, and but this might not be your local bank, right? You have to ask specifically, and they will understand more the equipment that you're using. When you deal with dealers and manufacturers, ask them, do you have anyone that you can recommend? Because most likely they have either worked already with different lenders, or they get calls from different lenders about it. And typically those are the lenders that are also familiar with the equipment in the industry. So those are your 3 main buckets, so to speak. There are brokers, and I want to talk about brokers. Brokers are essential, but they should not be your primary source of financing. And why do I say this is brokers are basically, all brokers do is you come to them and say, I'm looking for financing, and then they talk to all different banks in the background. That can have bad influence on your credit scoring because they pull your credit report multiple times on the business side. If you have given them your social, they will pull it on your personal side. So it can have really negative effects on your business and on your personal side. Brokers are more expensive because they're making a fee with what they're doing. And that fee is not cheap. They're typically 3 to 5% of the equipment that you're financing. So it is a source if you have no other option. If your primary bank doesn't finance you, if a typical equipment lender says no to you, and even working through the options with a dealer or a manufacturer, if all of these are like, no, we can't offer you financing, then you can think about going with a broker. The difficult part is that it's not so easy for you to see if it is a broker or not. It doesn't say equipment financing broker. They don't need to have the word broker in their name. So when someone calls you and say, hey, I'm from ABC Equipment Financing, I've heard you in the market to buy some new equipment, or we want to introduce ourselves. We love to finance equipment for your company. Do you have anything coming up soon? You have to specifically ask, well, who are you? Are you owned by a bank? Are you a broker? Are you related to a manufacturer? These are due diligence questions you have to ask from your side. It's something I've seen that people get burned with brokers, and it's just something I want to make everyone aware of, that something to be careful about. The SBA program, the Small Business Administration Program, is a really cool program. It gives you nice flexibilities. You can go 10 years, sometimes longer. You have no prepayment penalty. You can pay it off at any time without a fee, but it's expensive. Interest rates in the markets are below 7% right now. If you go with an SBA loan, you're prime plus 3%. So you're quite a bit more expensive. So who is an SBA loan good for? It's for businesses that can't get money any other way. That is the purpose of an SBA loan. This is not for the one that goes to the local bank and gets $1 million approved very easily. This is when you don't have any other options. If you're a startup, if you're growing your business and you can't get financing done somewhere else, you look into an SBA loan. It is government guaranteed. This is how it makes it easier and better for the bank to approve a deal, because they're typically 50 to 80% guaranteed by the state or by the United Nations. And that's an option. So we've done SBA loans, and because there was no other option for the customer, it helped him grow his business. He just had pump service, and then he added a drilling rig, and now is also doing water well drills. It has helped them tremendously. But again, this is also not your first option because it is more expensive what is traditionally available in the market. We had in our presentation when we did it, we wanted to have a little bit of real experience, like case examples. A lot of people think if I buy new equipment, that's a lot more money I put out. It's a lot of more money I have to pay every month. And they don't see the other side of it. So typically, and again, it all depends on every company and the person behind it and how you run your business. But usually when you add equipment to your business, or if you buy newer equipment, also with that, you can grow your business. We had two examples here in our scenario. We had a company, revenue was about 2.5 million in revenue, profitable about 20%. So that's the money he walks away with at the end of the year, is 20% profit. He added a new piece of equipment to it and was able to grow his company by about 500,000 in revenue and increase his profitability. Typical factors with how you increase your profitability is you have less service and maintenance, you have better production with newer piece of equipment, and by having better production, you can also bid more projects because you get done quicker, and that's how you drive your revenue. We've also looked at companies that basically took over another business and expanded regionally into another area. When you buy a company, you usually buy it with all of their assets. Some of them are just old, so you have to invest in newer equipment. And that is the company B here at the bottom. I'm trying to move the pictures a little bit. There again, you can see with adding new equipment to it, there's a revenue growth and a profitability growth for the company. And I think we're almost at the end. We have maybe one or two more slides. I think this is what I see when I go to these associations and I talk with a lot of companies. They're very hesitant to invest in equipment. And I think it is a real game changer. In one of the slides, let me see, I don't know if it's here. Oh yeah, here. If on the top right side, you see the gentleman with the walking support, he is 98 years old. He just bought a new rig, a new 50K in May this year. He's still the owner of the business. So there's never a bad time to grow your business or invest in new equipment. He was not hesitant to do that step. He's going to pass it on to his nephew eventually, and he wanted to set the company up right. But yeah, don't be hesitant. I'm not saying being foolish and just buy equipment and don't worry about anything else. There's a lot of work that is behind it. But I want to take a little bit away that fear in buying new equipment, because it's kind of unknown. How does it work? Will it really be beneficial for me? There is a lot of positivity in that. Yeah, don't let cash strain slow you down. So there is equipment financing. Don't feel like if you can't pay cash for it, you can't afford it. I think that is a little bit outdated. And partner with those that see the bigger picture. If someone says, I'm happy to do equipment financing for you or finance your next big purchase, ask him how much has he financed before. You will quickly realize if this is his first year in the water well industry or if he has done some of those in the past. Why do I say this? Is because if it's his very first year in the water well industry, it will take longer. It will frustrate you because you might not get to the finish line. So that's the end of the first presentation. Before I start with the second one, any questions at this point?
Nothing in the chat. So
okay, perfect. All right, trying to pull up the next one. Here we go. Okay, so next presentation is the ins and out of the credit approval process. Oops, one too far. So we talked about why do we do equipment financing. We talked about what that process is, figuring out you have a need, find the manufacturer, the vendor, the dealer, think about equipment financing, think about deposit, and then that process. Now we're going into that little box. How does equipment financing look like? So now we're talking about dealing with the lender, with the bank, with the equipment financing company, and the steps that they take and understanding what happens on their end. When I deal with customers of all kinds of sizes, there's sometimes not a good understanding why a credit person needs certain things, and we will talk about that. Upfront, it's not that the credit person is nosy or tries to make people jump through hoops that they don't have to. A credit person can only make a decision based on the information they have, based on the financial they're looking at. And that's based on that, they're trying to figure out, can you afford the rig or not? And the more information you give and the better you prepare that information, and we'll see that on the next few slides, the easier the process and the more successful the process is. There is so much business in the equipment financing industry that underwriters get deals in day after day after day, and there's a lot of pressure on them. The more there is back and forth on a deal, the less attention you will get and the slower the process is. I see this over and over again. And that's why I really want to talk about how does the process work? What do you need to provide? And what are the ins and outs of it? So, ins and out of the credit approval process. So, understanding the process helps you get through it faster and avoid delays. So, we talked about this already. So credit isn't just a number, right? We talked about they're looking at the financials, they're doing their analysis, but they're trying to figure out the background, your years in business. Can they trust giving you that money? So you have to tell a story with your business. And everyone in the water industry has a fantastic story. Honestly, and again, you don't have to go too much in the detail, but just simply the fact, oh, this business has been in the business has been in our family for generations. That is already a great story. That means you grew up with it. You know it. Everyone knows you're in the market, right? You have basically a steady income. We know there are ups and downs, right? This is normal in every business, but you have the best background because it's been in your business for generation. Or you started the business, right? You have worked for someone for 20 years and now you had the opportunity, or you take it over from the previous owner. We've had that as well. And you're basically buying it out from the previous owner and you're paying them off. And that is another good story, right? You continue the business in the market. Be good prepared. We talked about it. So you have a faster approval on better terms. And getting approved is not about perfection. It is about readiness. Have it already all set up from the beginning. And we will talk about what you need to provide. So small ticket, credit application only. That is your credit application only process. You only have a credit application. That is simple. That is easy. There's not much to talk about, except they will always ask for the owner and your social security number. You do not have to fill that out. Again, please ask or please say, we're happy to talk about a personal guarantee at a later point, but we don't want to provide it. Then they might come back and say, it's a requirement. We only do business with personal guarantees. Then say, I've been in business for 30 years. I have credit history. I financed other pieces of equipment. I think we have a strong credit background. Again, it's okay to push back. Not every lender will accept it, but it is okay to do that. What is a little bit more time consuming is the traditional underwriting process. You sometimes have a credit application as well. Why is it needed? Because it just gives the general outline of your company, who's a contact person, what's your address, what's your tax ID. They always want to know, have you ever filed bankruptcy or not? We don't really see that in the water industry, but it is a question. And are there any judgments against you? We also don't see that in the water industry. So that's your credit application. Then they want to see the last 3 years of your business. Most of you, that's in the form of your tax returns. So now it would be 22, 23, and 24. That's your tax returns. The other thing they want to see is year-to-date financials. And I do hear that question often, well, why do they need to have that, or we don't have it? We're now in August. The bank wants to have a feeling, how has your first 6 months been? Is it performing the same as the year before? Is it maybe better? Is it worse? You're asking, $500,000, $1 million, whatever you want to borrow. He has to have an idea how you're doing this year. This can be in part of QuickBooks. or any other kind of financial platform where where you run your business. Some customers have their CPA, put those together. That's okay. That's usually a little bit more lengthy. But this is a very, very common request to have year-to-date financials. The equipment quote, I think that is logical to have that. And then a debt schedule. A debt schedule is very simply just to list if you have borrowed money currently, not in the past that you paid off, but currently. Do you own any money to a bank currently? Do you owe debt? And then they want to know what your monthly payment is, when it started, and when it ends. Why is that important? They just want to make sure, do you have enough, do you generate enough money in your business to pay your current debt and your new debt? And having an idea when that debt ends, because you might pay 5,000 on a loan right now, but this might end at the end of the year. So it's not a big deal anymore. Or you just started and this might go 7 years. It's quite a different pictures one way or the other. So what are other key criteria behind the curtain? What is the credit analyst looking at? He wants to know your time in business. Most companies have decades of experience in business, so that's always a very big plus. Also, another thing that is really going for the water industry, and banks know this, the industry is known to pay their debt. The industry is known to pay their lenders first before they go on vacation or buy yourself or going out for dinner every week or whatever it is. That is something really a big plus for the water industry, that it's known that people in this industry are very proud and they pay their debt on time. So paying debt and not paying on time is another story, but that they're paying the debt on time. They look at your credit score. We talked about that. There are a couple of bureaus that provide it. It basically just shows how have you paid your debt in the past. There is a term called debt service ratio that basically just says it's a percentage or it's a number. It's usually more than 1. So if it's higher than 1, then you have extra cash. If it's below 1, you basically can't afford the new piece of equipment. That is nothing for you to, that's nothing you provide, that's something they do in the background, but this is why they're asking you questions. They're looking at the value of the equipment you're financing. They want to make sure that worst case, if something happens, they know what the value of the equipment is. And they kind of want to make sure whoever you have dealt with in the past, that you typically paid them without delinquencies. Very rarely, but once in a while, I've been doing this now for 20 years, we're seeing a company that always pays late, 60, 90, sometimes 120 days late, almost on every credit or every loan they have. And it's just nothing lenders want to get into, right? They know it's going to be time consuming. They have to run after their money. And yes, you can charge for late fees and all of that, but that's not the type of business lenders want to go into. So that's something else they look at your company. What are questions that the underwriter will ask? Why are you buying this equipment? You know, he just wants to understand what the reason is. They like to know, are you doing residential work? Are you doing commercial work? Are you doing municipality work? They might want to know if you're doing geothermal work. A lot of businesses are going into geothermal as well. They want to know, who are your biggest customers? Are you only working with 3 big contractors in the market, or typically in the water industry, you have a lot of smaller companies or customers. It's usually residential companies, residential people that you work for. But do you have any concentration? Who owns the business is an okay question. Again, no social security, please. They just want to know who's behind it. How much are you? What's the work you have lined up? What you have in the pipeline? It's very interesting. Again, prior to COVID, I felt like companies had work lined up between a month to 3. Now, since COVID, I feel like a lot of companies have work lined up between 3 and 6 months, sometimes even longer. There is definitely a lot of work in the market. And then another thing is, what do you expect in revenue this year? This is a number you should think about. If you come back and say, I don't know, that's not really a good answer, right? They want to know, do you think you will be around the same as last year? Do you think you will do more? And I think all of you you've been in the business for so long, you have a good understanding and feeling about it. It's just something for you to know, to be ready to answer those questions. What are the pitfalls, so to speak, and you should really avoid is having incomplete or outdated financials, meaning you might submit 23 and 24, but you don't do 22, right? It's very standard for every lender what they require, so provide the financials that they require. Financials that don't properly line up. That's something your CPA can help you with, or your accountant. But we see that sometimes that from one year to another, they don't tie in together. And that's a big question mark for an underwriter, because then he doesn't know, is the one this year or the one before the more accurate one. Make sure you do your due diligence with the debt schedule. It is something important. They can see on your financial if you have debt or not. And if it doesn't really line up with the debt schedule, that's also a question mark. Distributions are very common in the water well industry. It's okay to take money out of your business, but just be ready to have an explanation. A lot of people take it out either to pay the taxes on the personal side. It's okay. People take it out to reinvest it, right? They might put it into a CD. They might buy stocks. They might buy real estate for it, whatever it is. Taking money out is always a question from a lender. What do you do with the money? And again, it's not that they want to be nosy or tell you what you can or cannot do. It's just for them, they need to understand where does the money go. So the more you are transparent, informative upfront, you can really avoid red flags. Make sure you have a complete set of financials. Make sure they're organized. They have all the pages. Sometimes when we ask for tax returns, we get like 2 pages. They always want to have the full set of tax returns. Make sure you're responsive. The more time it takes, the more attention you get on the credit side, because every deal that comes in, the ones that go quick and smooth will always get more attention. So make sure you're responsive. If they ask questions, it just helps getting to the finish line faster. And then find the right financing partner that really understands your business, that understands the equipment you're looking for, and has the experience that can present you internally within the bank in the best way possible. Yeah, so that gets me at the end of this presentation. And now I'm gonna move over to the next one. Do we have any questions here right now?
None in the chat. Does anyone have any that want to unmute? I don't see anyone unmuting, so you're good to go.
Okay. Very good. Okay. So next presentation. This is the one we did at the Jubilee, end of July. It covers a couple of slides that we already went over. It was kind of like a recap. Every year at the Jubilee, we talk about different topics. It kind of builds up. You kind of got the crash course of part 1 and 2, and now you have the consecutive one. Can I afford to buy a new used equipment? 10 mistakes to avoid when working with banks. And then we actually added another topic at the end, which is really good for this round as well. It talks about the one big beautiful bill and any changes that came out of it for the industry. So, um, 10 mistakes to avoid when financing equipment through banks. So number one, don't skip the research on the financing options. Um, this is what we talked about, making sure you do your due diligence, make sure you know, don't go with your first quote, even if you think it's 8.5%, it's fine, I can do the monthly payment. Do your due diligence, make sure you work with the right bank, with the right lender, make sure you're getting what you can afford and what you're looking for. There are a lot more options out there nowadays than there have been 10, 15, 20 years ago. There's an equipment financing association, and there are more than 350 lenders in that association. And that's not every bank that's out there in the United States. So there is a vast majority of sources out there that can offer financing for you. So do your due diligence, compare the terms, compare the monthly payments. Don't be shy to ask questions to make sure you get the best deal that's available for you. Again, this is your money. This is the money you work really hard for. And I want to make sure that you get the best deal possible. Don't overlook the total cost. So monthly payment is one thing, and that's okay. Don't forget about insurance that you have to pay. Don't forget about the deposit or down payment if it is required. There are fees sometimes associated with it. Ask about how do I get out of it, right? So you might sign up for a 7-year term, but you might want to pay it off early after 5 years. Ask about what's the way to get out. Sometimes they don't allow to early prepay, and you might not plan to early prepay, but you never know, right? You never know what's going to happen. So knowing how you get out is a really good question to ask up front, because once documents are signed, it's a whole lot harder to change it than changing it at the beginning. If you looking at a lease option, it can be a little bit tricky. If anyone is offering you a lease option, I would really like you to call me. It could be a really good deal, and that's okay, but there's a lot of in between, reading between the lines, that is sometimes difficult when we talk about a lease option. And the reason why I say this, I had a customer and he called me and he was super excited. I got this amazing deal, Anya, 5 years, and my payment is only, just making up a number now, $500. And I said, wow, that's amazing. And I do my little math and I'm like, you're not paying back the whole equipment with $500 a month over 5 years. But yeah. I said, can you send me the quote? So I look at the quote, and he had a fair market value purchase option at the end of 5 years. That was not his plan, right? This is your computer, you lease it, you return it, your car, you lease it, you return it. In our world, with the equipment we're buying, we want to own it. We don't want to return it at the end. So sometimes the fine print is a little bit difficult to find with lease options. So if anyone here is getting a quote and it has the word lease in it, then please call me, because I want to make sure it is really what you're looking for. Besides the monthly payment, there's sales tax you have to pay, and unfortunately, that's not always cheap. Depending on the state, you only have to pay it on the truck and not on the full investment. Make sure you find out, because if you only have to pay it on the truck, and Christina, I don't know how it is in Virginia off the top of my head, but if it's only on the truck, it has to be separated on the invoice. Do you know, Christina, how that is? Or anyone else in the group?
I believe so. I believe it has to be separated.
And you only pay it on the truck value and not on the full price?
I'm not sure.
Okay, yeah, I was just curious if anyone would know. Every state is so different that we're not allowed to give any advice on it. But also bringing the equipment to you, the freight, right? So there's a lot of more little pieces here and there. So your monthly payment might not be everything that you have to put out. Don't choose the wrong type of financing. So here's again the different options, this time a little bit more with pictures than with just words. Starting on the right side, that's our small ticket. That's the credit application only. You can do water trucks, you can use equipment, you can do attachments. It's a really, really cool tool. I cannot mention it often enough because it's so uncommon in this industry and is very, very helpful. But again, you have to build a credit history, right? If you never finance anything, you will not be able to get approved here. You have the loan, and that is 99.9% of the companies do the traditional long-term finance. That can be a loan. Sometimes it is a finance lease. Finance leases are more common in California. So in Virginia, it would be typically a loan. Here's, you can see, you see the word lease twice, right? You see it in an operate lease scenario and you see it in a finance lease scenario. Very two different transactions and how they're structured, but they both have the word lease in it. And this is why I mentioned up there, if you get anything with the word lease in it, please call me, because we got to figure out in what category you fall in and how that could affect you. You can finance new, you can finance used equipment, you can include freight, you can include sales tax. These are things to know. You don't always have to pay cash for it. 10 mistakes to avoid. Don't submit incomplete financials. That is really a big red flag on the credit side. The 3 years of financials, 3 years of tax returns, the interim statements or year-to-date statements. And when we talk about financials, and one time we did a session about what is included with financials, right? You have your balance sheet and you have your income statement. And why are these both important? And on the balance sheet, we see your assets and we see your liability, the money you own, and we see your equity on it. And then we have your income statement where we see your income and all the costs that you have. And sometimes people get concerned and they say, well, I always depreciate as much as I can, especially on the tax returns, because I don't want to pay so much taxes. And we all do, right? By all means, that's how you run your business successfully. But that's okay, right? Because with depreciation, from a credit perspective, that is cash neutral. Depreciation is not money that leaves your bank account. It's not money that leaves your pocket. It's just on the tax return side, you lower your taxable income. So for cash flow purposes, it actually gets added back to your available money to service your debt. And then year-to-date financials, I wanted to mention that here. So that's your balance sheet and your income statement. And sometimes they also want to see a comparison to the prior year. So if for this year we would provide January through June this year, then they often would like to see the same period for the year before. Why are they asking for this? Isn't it enough? I just show you this year. They just want to see what are the trends. Sometimes we have companies in the first quarter, they're very slow. And based on the first quarter, the bank might be concerned, will they really reach their year-end goal if the first quarter is so slow? But if you can show that the first quarter is always slow because it's the cold season, we don't work a lot in that season, we have to go very slow because of the weather and everything, then it just shows a comparable history. So sometimes people, I guess my point is I'm trying for the people to understand what's the reason behind it so that they can better prepare and help making that process smoother. Yeah, we talked about that with the distributions. Don't ignore your cash flow. So this is what I had just mentioned. On the tax return side, you try to lower your taxable income as much as you can. Know your numbers. If you had one-time expenses in that year, maybe you had an engine repair that cost you $50,000, or your rig you have one drilling rig and your rig was down for 2 months and you could not generate income in that month. provide that information, right? Don't hide it and try to think if I don't say anything, no one will notice. Numbers don't lie, and analysts are very good in analyzing numbers, and they will typically poke the fingers at these things. So if you share them up front, it's always better to say it up front than bits and pieces later on. If you maybe had legal costs, right? It doesn't happen so often in the industry, but maybe you bought a new company, you acquired a company, you had some legal costs associated with it. These are all one-time expenses that is good to highlight because they won't repeat year after year. Number, that's an example here. We'll talk about that example later again. Yeah, maybe let's talk about, I think, hold on, I want to close that mirror. So this is, we talked about it, having your taxable income as low as possible. On the left side here, we have a revenue 2.5 million. And again, if your company is much smaller than that, it's okay. I just wanted to use plain and vanilla numbers that we can look at. You have revenue of 2.5 million. You have your cost of goods. It's $1 million. So you have gross profit of 1.5. That's kind of like your operational income. And then you have your personnel costs, you have your depreciation, you have your insurance, you have your loans, your interest. That's your G&A and deduction. That's 1.4. And then you have your net income at 100,000. And this is what I mean. Sometimes companies come to me and say, well, my net income is really low. I don't think I can afford it. And if you go by that number, 100,000, and you look here, if you want to buy a new piece of equipment and it costs 1.25 million over 7 years, it costs you a little bit more than 18,000 a month per year. That's over 200,000. You feel like, how can I afford more than 200,000 per year if my net income is only 100,000? But this is not how a credit analyst looks at numbers. This is how a credit analyst looks at numbers. He sees that 100,000 and then he looks into the details. He looks in how much have you depreciated. This is the cash neutral number. Again, this is not money. The depreciation is not money that comes out of your bank account, not money you spend. It's just a number on paper. So he adds it back to the 100,000. So we have 100,000 plus 400,000. And then you have interest expense, which he adds back as well, which is another 50,000 in our example. And then you maybe have distribution of 100,000. So that's cash coming out. So how the bank looks at cash flow is not looking at the net income. They're adding all these other numbers to it that gives, in our example, a cash flow of 450,000. And now you can see why a monthly payment or a yearly payment of over 200,000 is affordable of a company that has a net income of 100,000. So it is understanding how the numbers come together and having it available to the analyst. And again, here, if you had a rig that broken down and you couldn't generate income, we had that with a company. It's just additional information that's really helpful for the underwriter to have. Not building a credit report, number 6, is another thing. I can't speak often enough about it. Again, I don't like credit either. I have 3 or 4 different credit cards. I mainly use one, sometimes the second one. I barely use number 3 and 4, but it builds my credit. So I forced my husband to have a second one. He has much better credit now as well. It's just a game you have to play. You don't have to, but if you want to grow and be more successful, then that's the game you have to play. Again, you finance it over 5 years. You don't have to stick with it over 5 years. Understand how you get out of the loan. What does it cost you? And then you can terminate it earlier. Using a blanket lien without realizing it. That's mistake number 7. Understand what are the requirements on the loan that is approved. If it's not clear, then ask. What is the security you have? What is the collateral that you have? I only want to give that piece as collateral. This is something, this is often not in the quote. So this is something you will see once you get the loan documents. So this is something you should ask. Not understanding personal guarantees. Again, I see this all the time. I tell them, don't fill out this section, and everyone still fills out the section. Protect your personal assets, protect you as a person, protect you with the personal guarantees. I'm not against personal guarantees. In certain situations, it's okay to give, but it's not the first thing in line. Read your financing agreements. It's complicated, they're long. I get it. I don't like it either, but you should understand what you're signing. Can you negotiate more than 50%? No, you can probably negotiate 1 or 2 or 3 things in the contract, but I just want you to understand what you're signing. You need to know how to get out if you need to. You need to know what's your payment term, right? Is it every 30 days? Is it always on the 1st? Is it on the 15th? Sometimes when you fund on the 5th, it's every 30 days. So it would be on the every 5th. Just understand in general how it goes. And this is very common again, even if you're approved and now you have financing set up for 5, 6, or 7 years, the bank most likely will ask you every year to provide financials again. Not because they all of a sudden say, we're going to terminate the loan, but they are required because they are banks. They are required to know how good their portfolio is. So they need to have updated financials. I get this quite a bit from customers that say, I'm approved and I make my payment every month. I don't want to provide financials. Again, it's not them being nosy. It's a requirement that they have, that they need to know how good their customers are performing. And sometimes they don't ask. Sometimes they have thresholds. If you borrow less than $1 million, you don't have to do it. But that is just something that happens. Make sure everything you discuss is in the loan documents. Don't trust the person necessarily, or ask, we talked about A, B, and C. Where do I find it in the document? And again, ask questions is always another important part. Don't wait until the last minute. It just takes time to go through the credit process. I would say most deals go within 2 to 3 weeks. On the credit side, 1 to 2 weeks, but then to wrap it all up. But it can also take longer than that, right? It depends who you're working with. It depends how due diligent they are in moving forward. So just give yourself enough time to go through the process, and don't start it too late. Yeah, that was a little joke at the end of the Jubilee. Talk to me first. Again, I'm just feel very strongly about the industry. I go to customers. I really try to educate as many people as I can. We also went to the Texas Association. We do online presentations for biofinancial services. It's just something we feel strongly about, and just don't shy away. We're here to help. I don't care if you buy a Jeffcovic or not. If you do, it's great. If not, it's okay as well. We're just here to support you. One big beautiful bill. That was the slide I was looking forward to. So Section 179 in bonus depreciation. I think every one of you have heard the terms. It's been a lot in the news or in print media. You run a business, you come across it. It was very popular a few years ago when we had 100% bonus depreciation. It tapered off over the last few years. We should have had 40% bonus depreciation this year, and this has changed now. Bonus depreciation with the One Big Beautiful Bill is back at 100%. Having the capability to depreciate up to 100% is an investment driver. We have seen it in many years before that if company can depreciate more and lower their taxable income, they're more willing to invest in equipment. So this why this is a very positive sign to grow the economy. Really important with the bonus depreciation is that one, the bonus depreciation is in effect starting January 19th of this year. So that means anything you purchase from January 1st till the 19th has 40% bonus depreciation. Everything afterwards is 100%. And that 100% will be next year and the year after as well. So it will not taper off. It doesn't matter, both Section 179 and bonus depreciation, if it's new or used. If you pay cash for it, if you finance it, it doesn't matter. It's available. There is an order that these two apply. The IRS requires you to start with Section 179 and then apply bonus depreciation. There are little different requirements with Section 179. There's a maximum amount you can deduct, and then it kind of tapers off. I have a slide on the next. We will just talk about it on a high level because your accountant or your CPA can run you through those options. Again, we're not allowed to really give accounting advice, but we want to make sure everyone is aware of it. The bottom line with Section 179 and bonus depreciation is that you get to the 100%, and it lowers your taxable income. The other important thing is, even if you have a negative with the bonus depreciation or with the 100% depreciation, if you get a negative income, it's not, you don't use it, you lose it. You have the option to carry it forward. So don't think, I want to buy new equipment, I want to depreciate 100%, but then it's negative and I lose the depreciation for the years to come. With the loss carry forward, you can take advantage of it, whatever you don't use this year in the following year. But this is something you should discuss with your accountant or your CPA, because it's a little bit different with Section 179 and with the bonus depreciation. Here's just an example. I always have an easier way to look at things when I see actual numbers. If I read it, it feels like very theoretical. But here you can kind of see the first column has just a description. The second column, standard, would just show if you depreciate it over 5 years. So every year you depreciate 300,000 with a corporate tax rate of 21%. You save $63,000 in taxes you're paying. With Section 179 in bonus depreciation, you reached 100%. It doesn't matter in our example if it's 1.5, 3.5, or 5 million, but you can depreciate 100%. And now you can see how interesting this becomes, because and this is accumulated investment, right? You can buy a lot of small things and add up to 1.5 million. And now you have a corporate tax rate, or your tax rate is 21%. You're saving more than 300,000 in taxes that you're paying. And this is why Section 179 and bonus depreciation are such big topics when it comes to growing the economy. And then the next slide is interest expense. This is something it has not been talked about a lot, but it's also a very interesting point to think about. It's how much interest you can deduct from your taxable income. There is a limit to it, and depending on what government it is on, it always changes. The terms you might not be familiar with it, and that's EBIT and EBITDA. And EBIT is basically earnings before interest and tax, and EBITDA is earnings before interest, tax, depreciation, and administration and amortization. It's a little bit like the cash flow we talked about before. But the important part of it is With the new One Big Beautiful Bill, it allows you to deduct more interest than in 22, 23, or 24. That's a benefit for you, right? So in I think I have an example on the, oh no, we have to go back here. Um, Here we had a net income of 100,000. We had the 50,000 interest expense. If you might remember, those were our examples a few slides ago. So your maximum dollar amount you can deduct is 30% of 150,000. I thought I had another slide here. With the EBITDA approach, so the big difference between the left and the right side is adding the depreciation and amortization back. And you can see we're ending up here at 550,000 total. And your maximum interest expense that you can deduct is 30% of 550,000. So you can see if you buy equipment, you want to depreciate and you're financing it, with the interest you're spending on the financing, there's a chance to lower your taxable income here as well. That's something that's not talked about very often, but I think a very interesting part to consider. And that is bringing me again to the last slide. Just a recap again, know the equipment, know what documents you need when you talk about equipment financing, do your due diligence in finding the right lender, understanding what they need. Again, they don't want to be nosy. They just need to understand the business. And the more they can understand who you are and how you run your business, the easier it is for them to say yes. And be cooperative, right? Be due diligent, provide a complete package, be responsive, avoid mistakes. It just leaves a bad impression, and that's not what you want at the end. And that's it. That brings me to the end of my presentation. I know we covered a lot. Some of it was repeating it a little bit, but I think it ties in much better when you look at different parts of the equipment financing process. What I'm most curious about now is getting a little bit feedback from everyone that is in the group here. I would love to know, have you financed anything recently? How old your equipment is? What's your hesitation when it is about growing your business? I just would love to get feedback so we can make sure we can support the industry and the Virginia Waterway Association better in the future. Everyone is so quiet now. So Robert, I'm going to pick you because you were the first person I talked to 1.5 hours ago. You will have to unmute yourself, or maybe Christina has to, but you've been in the industry forever and you tried to get out and it pulled you right back in. Have you financed equipment in the past, or have you always paid cash for everything? We still don't hear you yet.
I'll see if I can unmute him.
Just 1 second. Christina's working on it.
Bob, if you can just touch your phone and then touch the microphone.
How about that?
Ah, here you are.
Yeah.
Okay. All right.
Well, first of all, let me say that I have been out of the well business and the drilling business for, I don't know, 7 or 8 years now. I retired. So I have not purchased any equipment in regards to the well drilling business for that period of time. And looking at your presentation today, I wish I had seen this 15 years ago, 20 years ago.
Mm-hmm.
It's been very informative. Back in those days, we really didn't look at everything that you have gone over and elaborated on.
Mm-hmm.
I grew up, my grandfather started the business over 100 years ago, 1919. My father and uncle got involved in the business. So it was a family business that had been handed down over the years.
Mm-hmm.
My grandfather died. My father and uncle took over the business. As they got older, of course, I had two other brothers, so we all became involved in the business. I am not sure that we knew everything that we needed to know from a financial standpoint at that particular time. So, yes, we went to our local banks and we borrowed money when we needed to borrow the money. Cash flow in our business was never great. And then, of course, we went through the recession in 1980, 81. We owed over $500,000 at that time, had a contract for 400 wells in Prince William County. Interest rates jumped up to 18, 19, 20%. The 400 wells went away. So we got caught with owing over $500,000. Well, we found a way out of it. We paid everything off. But it was a long struggle. We bought different equipment over the years and were able to pay for it and continue the business. And like I said, I got out of it about 8 years ago and we shut our business down. I had a younger brother that died. And at that time, my older brother and I said, what the hell are we doing? Let's get out of this and enjoy life a little bit more. And that's what we did. So now I do well inspections for real estate closings. So life's been good. It's a great organization, a great business. And, most of the businesses back in those days were family run businesses. They were handed down generation to generation. Today, I think you're seeing a lot more people getting involved in the business that perhaps did not have a relationship with the older generation. It wasn't a tie-in. It was just something that they see that can be a very profitable business and as well as a very a business that is very rewarding as well. So, it's been a good business and I like to keep up with it.
Good. Thank you. Thank you for sharing your feedback. And I think that's what makes it so special when it's passed on from generation to generation. And there's not a lot of people from the outside coming in, right?
No, it's not. One thing I would like to add, when we were in the business, at one time we had 5 drilling rigs, and that was back in the 60s and the 70s, early 80s, before the recession came in. And most of the businesses at that particular time, they had 1 rig, they had 2 rigs. Well, the recession took a lot of our equipment away from us, not from losing it, but from a business standpoint, and we sized down. Today, I see companies in our area, such as Valley Drilling, such as Royal, some of the larger companies, Northern Virginia Drilling, that have 5, 6 drilling rigs, 3 or 4 pump hoists. They had frac machines. These companies are very, very successful businesses, and I applaud each and every one of them. There's some that I have not mentioned, but what I'm saying is businesses have grown to the point where it's not just a mom and pop organization, and you don't just have 2 or 3 people trying to run a business. I tried to run our whole business. As you get bigger, you can't do it. You have to expand, and you have to get knowledgeable people. That's the key. Knowledgeable people. If you don't, your business is going to hell in a handbasket. So you better get people that know, not just the drilling business, but the financial end of it and the operational end of it. So kudos to those big businesses. I admire them. I respect them, and they've done a hell of a job.
Yeah. Finding good people and that are willing to work, right?
Big key. If they're not willing to work, you better get rid of them real quick.
Yeah. Yeah,
From what
exactly.
I from what I understand today, and I won't say too much more about it, but it's so difficult to find employees that want to be in the business. There's too much handout in this world. So why are you going to go out and work your butt off? Well, drilling's a hard business. It's not
Yeah.
easy. So
Yeah.
why are you going to go out and work your ass off to see, excuse my French, but have other people come in that you've hired that are going to bring your business down because they're not willing to work?
Yeah. Yeah. Very true. I'd like to hear from a couple of other people, and I'm not trying to call anyone out. I'm just going by the names I see. And I see Gina, I saw you being online with us from the beginning. I would love to hear a little bit from you if you have anything you feel comfortable sharing.
Okay, I think I'm unmiked.
Yes. Yeah.
My grandfather drilled many years ago, and my dad's brothers were left the business. And then there was some situations that happened, and my dad ended up being Federoff Brothers. Excuse me. He died 4 years ago. My mom is running the business, so I'm an only child. We have two employees because we've run into the same thing. Nobody wants to work. We have great guys. I've got a driller that's worth a mint. And we do a lot of our work over in across the Whitestone Bridge, Northern Neck, all that area, deep wells, 500 to 80-foot deep. And there's not too many people that can drill that deep.
Yeah.
My problem is I have a mother who's 80 some years old who runs the business, and everything's old school, handwritten. I'm just having a time with her. So I'm just kind of sitting back and riding the tide. I mean, I don't know what to do with her. So
Yeah.
yeah, that's my story.
You have to slowly modernize it, right? Starting with
Yeah.
not everything being on a piece of paper, right?
Right.
Because eventually, if you want to continue it, I think modernization is the key.
You're correct.
Yeah, yeah. So
Okay.
have you been involved in equipment purchases? How have you guys handled it?
We just purchased excavator,
Okay.
cash.
Yeah.
Yeah.
It's okay.
We probably could use a new rig, but ours is right old. But our driller just, he loves that rig. It is his thing. So he's like, let's just stay with where it is. And my
Yeah.
mom, I don't even know if she'd even think about purchasing now at 84. So it's interesting.
Yeah.
I don't know if anybody else has problems with parents getting older, or if there's even families anymore, like that gentleman Robert was talking about, that things just get past it. I don't have any children, so that makes it rougher. Yeah.
Robert, do you have grandchildren you can help Gina out with?
Yeah.
I've got a daughter that's a state police in Virginia, and she has no interest or had no interest in the well drilling business. So I had no one else. And so, what do you do?
Yeah.
Right.
Yeah.
Yeah, it's tough. It's really tough. And I've worked in the business. I work behind the rig. I mean, I know all that stuff, but I never worked on the business side.
Yeah.
I was in the field for years.
Yeah.
So when he passed, she just pulled me back. And every time I try to okay, well, we could do this way or that way. No.
Yeah.
She's a great person, but she's just used to doing things her way.
Yeah.
So it's rough. It's rough. But
enjoy every minute with her. She's 84 years old.
Right.
So
yeah.
Absolutely.
Yeah. Wonderful.
Thank you.
Thank you.
Okay.
Thank you, Gina.
Sure.
Clyde Williams, I don't know if that's last name or second middle name, but I would love to hear from you a little bit. And we need to unmute you as well.
Can you hear me now?
Yes, now.
I just knew I was going to get checked.
You have that friendly face like everyone else.
Yeah. No, I've been in the well drilling business since I was a kid. I worked for Artesian Water Wells. I've worked for John Danielson Well Drilling for about 10 years.
Up in Vermont.
Well, no, this one is in Virginia.
Fredericksburg.
Closed down now. Wade Griffin, he's my foster parent. He adopted me and he gave me this trait when I was about 15 years old. I've also worked for Northern Virginia well drilling for a while, so this is really all I know. I truly love well drilling and water filtration and water systems. Of course, I've only been in business for myself for about 5 years. So, thinking about taking on the responsibility of financing a new well drill is a little scary.
Yep.
I don't think I have that kind of money. We do have we do have a lot of builders that we work for here in the area in Central Virginia. Um, like I said, I could drill a well with the best of them, but as far as the problems that come with having a drill, the breakdowns, the overhead, the diesel fuel, the CDL drivers you got to have taking it, that,
Yeah.
and then also the water truck, which is also over $500,000, to finance. Everything you said today was so knowledgeable. Like I think his name's Robert. He had said like I've never heard any of this before. Granted, I'm young, but just hearing those ways to get stuff financed, that it was intriguing. So I'm going to look into that a little bit. Maybe get
Sure.
just to
Yeah.
see if we can try to grow and take on that responsibility because it is a lot of money in the well drilling business. Even in just the water systems and well inspections,
Yeah.
filtration and other stuff too. I took a step to do the filtration and water systems, so I'm sure if I gave it my all, we could own a rig and go that route.
Yeah. Yeah.
Can I add something?
Yeah.
Uh,
Please.
when I was in the drilling business, and once again, go back 8 years, 9, 10 years ago, in our area, we were getting like $10 a foot for drilling. We got paid for the casing, whether it was plastic or steel. You got paid for your grout. Well, back in those days, in our area, roughly a 300-foot well, cased and grouted, just the well and the casing and the grout, somewhere in the vicinity of $7,000 or $8,000, depending on where you were located. Today, I hear stories, and I'm glad to hear this, to be honest, of drillers that same 300-foot well costing anywhere from $19,000 to $25,000.
Yeah.
And I hear this from realtors because when I tell them, I do a well inspection and tell them that the well doesn't have enough water to take care of a family of 5 when it used to be a family of 2. So, okay, now they have to go out and look at exploring the cost of having a well drilled, and they come back and tell me that they've gotten prices of anywhere from $19,000 to $25,000. I remember when I was a child seeing my grandfather's some of his invoices for a well back in 1930, 1935 for $500. Well was $6 a foot. It was $2 a foot if they were drilling in dirt, $5 a foot if they were drilling in rock. So you take that price from 1935, $6 a foot. 1980, 1970, 80, you're getting, even today, you're getting, not today, but 10 years ago, you were getting $10 a foot. And now all of a sudden that well is costing you $19,000 to $25,000 in our area. I'm not saying that every driller charges that amount, but the prices have gone up.
Yep.
Of course, the prices of equipment has gone sky high as well, but well drillers need to get paid for what they do. It's not easy work. It's hard work. It's difficult. And you tell me one person in this world that can live without water. Nobody can. So put a price on the value of what you're giving that customer. I just want to see well drillers get paid what they deserve.
I agree. Thank you. I've had a customer bought a new rig and then said they were a little bit worried about using the rig, right? Because we had this old rig and now we're having a new rig, and the customers might think, right, they're rich, they bought a new rig, it's a big advice. They felt bad about it. But right, you're only servicing your customers better, right? And it's a safety thing as well, right? I mean, you all know much better than I do all the things that can happen on a drilling rig, and the newer rigs have such more safety um, on the rig that it's really helpful. And it's the production. And that has only been a topic for about a month or so with the customer, and then it went away. It was, I think, more in their head than the customer's head. But that's another thing, right? And I agree with you. This is hard work, and you should ask for the money you deserve for it. And don't feel like the COVID years that have spiked that inflation so tremendously high. So
Totally agree.
yeah. Yeah. Dylan, the one with the other friendly face on it.
All right, I've been let's see. My grandpa, his father, he started it all and then he passed away, so my grandpa he got his own and he started drilling or whatever and I had been with him ever since like Clyde. I've been doing it ever since I was a little kid. Ever since I could walk. I've been out there
Yeah.
by his side doing it with him. And then when I graduated high school, it was either go play ball or drill wells, and I chose to drill wells because that's
You
what I've
played
been
with the big
doing.
stuff.
That's what I've been doing my whole life with him. So I've been, let's see, it's been about 7 or 8 years I've been doing it, pretty much on my own, but
Yeah.
he comes with me, does the pump work stuff. I'm the driller. So
Yeah.
now purchasing a new rig, I've actually thought about it, but he kind of leans me more to no, because you're not.
Yeah.
He says you will not sleep at night. He says,
Mhm.
and you got the winter. That's your downfall when you can't get. You can't really get into places for the weather, so you don't have any money coming in. So it's basically what money you've made. You're taking that and throwing it, and then say something happens, you don't have the money to fix it.
Mhm.
So me personally, I would love a new rig. I run a
Mhm.
1982 Ingersoll Rand T4,
Yeah.
Happy damn.
and I love it. So
Yeah.
I sit back and I tell myself, I said, it would be great to have another rig with all the people I drill for. They're coming in constantly every day, and you never can get caught up.
Mhm.
But the T4 I run, it might as well. It's got everything on it. It might be a 1982, but it's got 2021 and parts on it.
Yeah.
So and I can get in it and I can run from Lynchburg to Petersburg. It might take me a little while to get there, but it'll get there, and I can get in it and go, and I can raise the tower up, drill a well, and tear it down, go get another one. So at this point, like I said, I'd love to have a new one, but that one's getting the job done. So.
Yeah. Yeah. There's a right time for everything, and I agree. Like money worries is the worst one because it doesn't let you sleep at night. So it has to be the right fit. I want to say in general, banks will not approve you unless they really think you can pay, right? So it is kind of a good check mark for you if the bank approves you for a certain amount, then they are, right? Banks don't want to have risk, so they will lower their risk as much as they can. And so if you get approved for 500,000 or less or more, whatever it is, right? Then that should be a really comfortable range for you. And maybe it's something you have to go through, but whenever you're ready for it, right? Because it is a time investment, right? It's not just talking to someone and throwing your last year tax return at them. It is a process where you need to put some time aside, but maybe it gives you a good guideline what they think you could afford right now. And maybe you find something at some point newer in that price range, or maybe you wait another few years and then do the process again.
Yeah, I think
Um,
I think I'm gonna I think I'm gonna run that T4 into the dirt until
yeah,
until I decide that I need it because 1982, yeah, that's
yeah,
antique. And she's
yeah.
antique, but she
Lots
will
of
she will
memories.
drill she will drill with the new ones. I can promise you that.
Yeah,
She
yeah,
will cut a rod in 10 minutes, no
yeah,
problem.
yeah.
But it's like going back to being young or whatever. I had this little truck with some little angle iron rods on it, and I would pretend like I was drilling beside my grandpa.
Oh,
And I left a I put when he put I put a cap on my well, he put a cap on his. This is no lie. We had the health department call us and say, which one of these is the well? Because I would dump water inside the well and it would still be there.
yeah. That's a great story. I want to check in with one more person. Do we have anyone that would like to say something? I know we have a few more people here. I see Denise, I see Zoe, I see Tara, I see
Paige is from a family-run company. I don't know if she's able to chit chat, but she's from a family-run company,
yeah,
Culpepper.
yeah.
Her and her two brothers.
Mm-hmm.
Oh,
Yeah.
Paige, would you like to share a little bit about you and your business? And I don't know if Christina has to unmute you. No. Okay. I know we saw Todd earlier. His picture popped up. And
here.
oh,
there's
here.
you.
Oh, wonderful.
I had to bring in a younger generation to unmute it.
Yeah.
Anyhow,
Okay.
hey, yeah, my dad started the business and he taught us everything. And I guess we just couldn't get enough of him. We just kept on right by his side. Then he was a sole proprietor. He always said, look, y'all are gonna have to LLC to carry on the business if something happened, and something happened. And but we kept on getting it, which is what he taught us to do. I'm going to get emotional here because it's been a he was a good teacher, and he always said every time we got on a bad well, one that you end up losing more money on than anything. It felt like he said, well, that's our education. You know, people go to college and blah, blah, blah. And he said, well, we've done our education for the year. We've paid for that education 1 year of college. But anyhow, but we've carried it on. We have experienced buying new equipment. We have a 89 and a 91 Ingersoll T4. And I got to say, it was probably one of the worst experiences of my life. We just about lost everything because of it, because of one.
Wow.
And when I say everything, I mean everything, house and both rigs. You go in, you think, okay, you're pushed so much sometimes by your customers that we felt like we've got to do something because we can't get there fast enough and get it done fast enough. Because over here in our area, we do get into deep wells. We get into 1,000-foot wells, 900-foot wells, no water. We do frack, but fracking is not in every area. It depends on what type of rock you're in. And, like Mount Pony, Bob.
Yeah. Oh, yeah.
You can't frack over there.
Oh, yeah.
Now, you get into these deep wells and you're there for a week or so. Well, that pushes everybody back. And when times are good, they're good. But when times are bad, they're bad. And but we kind of felt like we were almost forced into just going ahead to keep our builders happy to purchase a rig, and we did. And it was good for a while. But then stuff started slowing down. You still got to make that payment. Payment is not like a truck payment or a house payment or anything like that. You got a 12. This was in the 90s, so we had an easy $12,000 a month payment. I don't even know what it would be now, but so, and also in the 90s, the builders were working on draws as opposed to, right now it feels like, when you send in your invoice, they pretty much send them out. But draws, sometimes you'd wait 30 days for your money.
If you're lucky.
Yeah. And then you got one out there that just doesn't have it. And you get a few of those. Next thing you know, you're behind. Then you're behind again. So you're owing 20 some $1,000. You're trying to make payroll, and we're just family. We didn't have a bunch of employees or anything like that. We worked 12 plus hours a day, 7 days a week, trying to get the job done right, and then get paid. And that was our biggest problem, is just getting paid. The money was owed, the work, we had it. The money just wasn't coming up. But we were financed. The company was Associates. I don't know if anybody ever remembered them, or maybe they're still around. I don't know. But I swore up and down they were the mafia. I'd never experienced anything like it. And they came down. It got to a point that, well, I decided, I was like, we've got to do something. And I went to our banker and I said, look, we're in trouble. This is what's going on. And I remember staying up for at least 24 hours getting our books in order to try to get the bank to refinance. I told Associates that I was refinancing, they were ready to jump on the plane and come see us and see these rigs and ready to pick these rigs up. They got mad. And it was a matter of, let's see how fast my banker could work. And I had a very, very good banker, and we were truly blessed.
Good.
Because he came in and he refinanced us, brought our payment down to half. So I was only looking at $7,000 a month, which was nothing compared to what we were paying.
Yeah.
Of course, you have a balloon payment at the end, but he stretched it out to 7 years. And then at the end of that 7 years, we had a balloon payment of like $100 and some thousand. We made it.
Yeah.
I'd probably never, ever buy a new rig again. I like what we have.
Yeah.
Whoever has the T4, the 80, whatever T4, you're lucky to have it. Keep it and just refurbish.
Oh, don't worry. She ain't going nowhere.
I mean, because you've got something.
I got everything on it. Hell, I done deleted the cooler system on one side and put it all in one on the other.
Yeah.
It's got a 1070 350 on it with a 3406 cat motor. She'll go.
Yeah.
Yeah. So that's me.
Good
experience.
Well, I'm sorry you made that experience. Luckily, there's only, not everyone has to experience it, but I hear you. This is with me going through the financial crisis. It broke my heart, right? These small businesses, and everyone here is the same, right? You're so proud of your business that you feel like, I have no problem giving a personal guarantee, but banks are not nice when they're worried about their money. And that's why I'm very against personal guarantees unless it really has to be. Again, sometimes you can't avoid it. And then that's something to talk about, but it shouldn't be a standard. And I really appreciate that everyone in this industry is so proud of their business. But this is what you work for so hard, right? So kind of protect it as much as you can, and same page with those liens, right? If you only have the one piece given as collateral, they cannot get the second and the third piece of equipment that you have. But these are fine things, right? Unless you're working in the industry like I do, you wouldn't know what the difference is because no one explains it.
Yeah.
So
yeah, thank you, Anya. I mean, it's been hugely educational and informative this morning, especially the whole personal liability aspect of it, because there's virtually nothing today as a company owner that when you go to the bank for, it's always a personal.
Yep.
So.
Yep. Very
Hell,
true.
most banks today will tell you they don't even got it. They don't even got it to lean it to you. Or it's like you put 100 grand in the bank and you say, "Can I get the 100 grand back?" They don't got it because they don't
Yeah.
lend it out to somebody else.
Yeah. Yeah.
They'd like you to have double of what you're asking for.
Exactly.
Yeah.
Exactly.
So yeah, the banks are not in the risky business, right? They're there to lend you money and still be comfortable and sleeping well at night. So yeah. Okay, very good. Well, Christina, thank you so much for setting this up. Thank you so much for the opportunity to present about equipment financing. I know we met at the annual show, and that was February, right?
Mm-hmm. Yes.
Exactly. So yeah. And anyone here, if you have questions, Christina has my contact information. Again, I'm here to help. Just want to make sure everyone has access to the information and makes the best decision they can for their company.
Absolutely. Thank you, Anya. And we'll be sure to share this as we do get a lot of conversations and questions about how to grow a business. So
yeah,
it'll be utilized.
You got to keep turning it to the right. If it's turning to the left, you're going the wrong direction.
Yeah, you'll unscrew them.
Yeah.
Yeah, that's a signature line. Well, thank you, everyone. I'm going to go ahead and we'll close up today and we'll see you guys next week.
Thank everybody. Fantastic. Enjoyed it.
Thank you. Thanks, Robert. Bye-bye.
Bye-bye.
Bye, everyone.